now, later, sorry, later the list in the end of the presentation, so you can come back. So for this year, we're gonna be at the last Wednesday of the month at 2 p.m. always. Next year, we'll change to Tuesday. Okay, the same time, 2 p.m. So this will be a monthly, except for the month of January. So there will be 11 seminars per year. So thank you very much. If you can start your presentation.
Oh.
So just before, so how this will go? 45 minutes to Luiz to present. Then I'm going to discuss the paper for 5 to 10 minutes. And at the end, we can do some Q&A. You can, during the presentation, put in the Q&A section here for the participants. You can type your question. I'm going to relay them to Luiz at the end of the seminar. Okay, so thank you all, and let's start the seminar.
So thank you, Rodrigo, for receiving me. Good afternoon to everyone. So I'm Luiz. I'm a PhD student in the 4th year at PUC. I'm currently in my exchange Doutorado Sanduíche, an exchange program here at Columbia University in New York. And this is a paper that I've been working for since 2020, I guess. In the beginning of the COVID pandemic, I got the data, and then I started to run some initial regressions. And some days later, it was concluded, let's say. But it's every time it's good to receive more feedback. So please, if you have any comments, send to me because it will be very useful. Okay, so this paper, in this paper, I'm studying how local credit market seasonality plays an important role in the transmission mechanism of monetary policy. So basically, the story behind what I hope you understand, you learn at the end of this presentation, is that distinct credit markets can react differently for the same change in a monetary policy. So let's say that Copom decides to increase in 0.5 the interest rate for Selic, right? And then what will happen with the credit volume? What is expected, the banks will find a high cost to acquire money, and then it will be transmitted to the firms and borrowers as a decrease in the volume of lending, right? So this has been very widely studied in the economics literature, in the banking literature. So for instance, Bernanke Gettler is one of the first papers to give the names for the mechanisms. So they describe the credit mechanism, which is divided in bank lending mechanism and balance sheet mechanism. So here I'm going to explore deeply the bank lending mechanism, which is more related to how banks, or in my case, branches, will react for a change in interest rates. So when another example from early ago, like 22 years ago, which is a very interesting paper with the title is what 2 million of loans can say about transmission of monetary policy. That is this paper from Cash Epstein, and they find results for larger and more liquid banks. Currently, more recent data, we have these two papers, Huber and Goin, which is more, they explore these channels that I've mentioned are still being explored and also frequently revisited with more granular data or with better identification hypothesis with exogenous sources of variation, which is something that I try to do here as well. So basically, these papers explores both are from Germany. The first one, Huber, is an AER paper, which is exploring how this mechanism of credit of bank lending mechanism of for a change in interest rates, how does it affect loans. But in the particular case of Germany, the loans there are they vary. So it's not like here when like in Brazil, when you get a loan, you already know the interest rates that you are going to pay. For Germany, from Portugal and other countries, it is more common to obtain loans that vary with economics. So it will be a more risky approach for let's say a firm to obtain credit. So here another important topic is to respond not only how, but when the monetary policy is more effective. So this interesting paper from Oliveira and Tenreiro, they find that for higher increases, for increasing interest rates, in the first and second quarter, the effect is more pronounced in the GDP, which is different from what I will explore here, but the question is similar. And the explanation is that because most of the contracts, like employment contracts, they are made in the beginning of the year. So which is in the case of Japan, for instance, the most of the contracts in the middle of the year. So their two main quarters will be the third and fourth, for instance. And other papers, these two, for instance, they are exploring how when monetary policy is more effective. Both of them is showing how banks protect their clients, their firms, during periods of crisis. This is a rather old, let's say, evidence, but as I said, more recent papers are visiting with better data, better sources of information. These two, for instance, use both of them. They use the interest rate, the financial crisis from 2008. So this which will be in this one can argue that no one can argue that was not an important effect, right? Important crisis. And also a third question that I plan to explore here is which kind of bank branches, in my case branches, so I'm exploring more granular data than usual, which kind of branches do protect their clients the most. So there are extensive literature exploring these heterogeneous effects. I will explore it here too. And basically exploring banks are large, from public branches, more liquid in less concentrated markets with longer relationships. This is what has been found so far, okay, from several other countries. But it is important to mention that all of these studies that I'm citing here are studies, most actually Joaquin et al. Is not, but most of them are based in bank characteristics. I'm exploring a deeper level, which is the branch level, okay? So the motivation for this study is basically, I did it in a map, but since this map is no longer in the article, I decided to show it as a table. So basically, if I ask someone, and as I did several times, if I ask a loan officer, hey, what do you think is the most important month for your branch, the branch that you work, in terms of lending? Most of these people will respond December, and they are indeed correct, since 22.17% is in December. But see, November is the month with more branches in its main month. So basically, a lot of branches have December and November as its main month. But see, there is a very heterogeneous dispersion of this variable along the months. Okay, I'll explain this variable main month deeply, but it's basically the month in which the branch it's more important for a given branch in terms of lending. It's the month in which their clients most demand for a loan. Okay. And here I noticed this pattern, and I noticed that well, the competition will be an important topic to be explored here, because in some moments a branch will not be able to increase the cost for the clients, because if they do, it may harm its future relation with the clients. So basically, two distinctive hypotheses came to my mind. So the more traditional, let's say, and based in a very traditional banking model, which is Bernanke and Blinder. So due to diverse selection, if the interest rates rise, the bank will attract the branch, or the bank will attract more risky clients. So banks, to avoid giving credit for these risky individuals that accept a higher rate, what banks should do, they must reduce their credit supply and deny credit for those clients. Okay, this is the traditional, let's say, link between these two variables. However, if you think into a new Keynesian model, which is basically what, how the transmission of monetary policy occurs in the economy, or how several macroeconomic shocks are transmitted to economy. Basically, there is this parameter that firms have called price stickiness. What is it? If you, it's not free for the firm to change its prices at every moment. At sometimes it is given exogenously. So here I'm exploring a similar feature. Basically, I'm saying that it's not easy for a bank to change its price of credit at any time it wants. So when it will be more pervasive for the bank, when the branch is in its main month. So basically, this is the month with the credit in which the demand for credit is in its peak. If the branch increases the interest rates, for instance, it will send their borrowers to other banks, for instance. Okay, so denying credit may harm this relationship with their clients and lose lose its credit for other branches that are in its main month, for instance. Okay, so basically the question is, banks so branches will increase or decrease lending when facing an increase in the interest rates. So this is the main question: how the branch will react, the credit market will react for an increase in interest rates. So what do I find? I find that, so this is the three questions I've shown before. During this main month of historical lending, branches in fact increase lending, even for a contractionary policy. So what is the expected role of banks in transmitting monetary policy will be harmed here, because they will kind of protect their clients from those increases in interest rates. When the monetary policy is more effective, I find to be January, June, and December. And I will explain later why those months, rationale for why those 3 months are more important. And February and July are the months in which the branches cannot protect their clients so well. This is the point in which monetary authorities should aim, in this point in time, when monetary policy should aim to mostly affect the economy. And the third question is, which kind of banks protect their clients? So I will say that those with lower market share, because they have more incentives to compete, from private banks, branches from private banks, and those branches that are for a longer period of time in that given market. These are the findings that the major findings that I present in this study. So now I'm going to try to convince you why this is the case. So first of all, why am I studying Brazil? I have several reasons, but mostly I'll present here 5, which is Brazil is far from the zero lower bound, so we did not face several problems with respect to reacting to those incentives, to those changes in interest rates. And Brazil can control. So it's not the case, let's say, as Europe, which you have the European Central Bank that controls the interest rate for several countries. Also, Brazil presents several changes in its Selic rate. So in intervals of 45 days, there is the COPPEAD meeting. This monetary authority sits in a table for 1, sometimes 2 days, and they decide for which interest rate will be valid for the next period, and then the market makes its role in adjusting these expectations. And this not only these COPPEAD meetings happens, but there are several in fact changes in interest rates. Okay, so another thing, that Brazilian credit market is one of the most concentrated banks in the globe, where the branches will need to struggle more to obtain more market share. Okay. Also in Brazil, most of the firms, as in Germany, but Brazil's most of these firms are small, and for small firms, it's not easy to find an alternative source of financing. And also the entrepreneurs many times are not very literate people in terms of finance, knowing about finance. So they mostly rely on banks and its relationship with banks for getting credit. And also because Brazilian data is very good, we have the public available data, which enables me, the researcher, to conduct analysis at a lower level than usual in other papers. So let's go to the data though. So the time span, I'm getting data from January 2006 to December 2020. It comprises 180 months. Basically, I did this analysis in a previous version of this paper, where until December 2018, the results are the same. So I'm getting data from a large number of branches and a large number of banks over this whole period in a monthly basis. So I will have 3.4 million observations in my data set. So you imagine that the regressions take a little time to perform. I get also data from these COPPEAD meetings, which comprises 119 meetings, not necessarily changes in interest rates, but several meetings, which is more important for me. I also get data from the focus group. This is a specific around 130, the last time I saw, group of economists from banks in Brazil that provide their forecasts. They say daily, okay, but if you see the data, go deep in the data, you see that there are not many changes from one day to the other. Then I got from one day before, and this is important to constructing my measure of interest rates, which will not be simply the Selic interest rate. I will explain deeper, but for that, it's very important to obtain this median forecast, which will be here a measure of market consensus. So if the individual right there in the middle thinks of that, well, it will be likely that the whole market thinks the same, okay? And also I'm getting IF data, which is more related to bank level, but it gives me an important variable that I do not have in the SGBAN data set, which is the ownership. And if you see, the number of public and private branches are very similar, but also I'm making another division here and adding the number of foreign branches in this data. So how I plan to convince you that this is indeed the case? My identification strategy is basically interacting these two important variables called main month and unexpected Selic. So first of all, the unexpected Selic is basically, I subtract this 1 day before a coupon meeting, this forecast by the median forecaster, to compute a measure of an unexpected change in the cost of capital. So in unexpected change in Selic. Basically, this is a variable, if you notice, that varies only over time. So it's the same for all the branches or banks in Brazil. It's just one for the whole economy. But when I interact with the main month, which is a variable for the branch and municipality, so basically so now I guess I'm back. So so for the interaction of these two variables, main month and unexpected Selic, I get how the effect of unexpected change in interest rates will affect every different branch in the country. So this is a very granular effect, okay? And for you to show you how it is very close to the reality, this is the variation in Selic rate and followed by the 1 day forecast. So there are some large errors here and here, but mostly the two are walking very closely. And by the correlation, you see that this is indeed the case, okay? So my forecasters are doing a good job, basically. Another important variable is this main month variable. That is, I get data from 5 years for each branch, at least 5 years, and I compute this variable, which is basically I rank all the observations for this branch. I require at least 5 years, but it can be more. And then I compute. Let me show an example. It'll be easier. So basically, this is the raw data, which is with the lending volume. So I want to call attention for this. This is the case in which December is the month with its highest lending. And I'll say this because this is when I rank them. So I have here the lending volume of 70 and 30. But in terms of ranking, it's the 10th and the 9th with highest lending. When I do the average per month, I obtain this December as the month with the highest average ranking. Okay, so basically this is then I also show the results for this continuous measure of ranking, but I show here most of my cases I transform my variable into a dummy variable for making it easier to understand. Okay, so basically exploring if the branch is in its main month or not. Okay, and to show you how well it captures the seasonality, this is a very interesting graph, which in a darker in black here I have the movement captured by the seasonality, and in the gray one I have not see much of this pattern. See, it's very a straight line, but in December there is a decrease, which is consistent with the idea of a market competition. When December arrives, branches mostly have to provide a credit, otherwise it will lose their clients. So, and it's highlighted here the month of December, so just for ease of visualization. Okay, so this is my identification, my regression. Basically here, what I will add in some cases will be in most cases actually, a branch fixed effect, which will allow me to compare the same branch with itself in a different month. So you can think of this main month linked with the branch fixed effect as the month in which I'm comparing the same branch as if it was treated and controlled, but the branch will only belong to the treated group from 1 month in the year. The remaining months of the year, that same branch will be its control. So in terms of identification, you can think of this in a similarly to a diff and diff, but with this particular and important for identification setup in which the same branch is its own control. Okay, and here I also compute a month. It's monthly data, but it's a municipality month year fixed effect, which controls for every kind of shocks that affect all the branches at the same month in the year. Okay, so this is a very important control, because since I have branch data, I can look at the local level. I can control for several local level, local credit markets characteristics, which may give them confound my results. So here I'm controlling for a numerous number of things. In previous experiences presented in this paper, most of the times when someone provides me an alternative explanation, it may be ruled out because such a granular level of analysis and such a specific fixed effect that I'm including here. But if it was not the case, I still have some controls that I present, that I'm including in most of the variables, which are lagged 1 month, just for avoiding the bad control problem presented by Angus Tepishik in their book. So basically that's it. And my main assumption is, because this main month variable is coming from a demand of clients, so I use the demand effect to identify a supply effect, right? So basically not other supply event is occurring affecting one group more than the other, so affecting more the main month rather than the non-main month group, but that's not related to that time, that municipality, and that branch characteristics. So it's a very unlikely that other event may be happening in this setting. Okay, so going to the results, this is the main result of my study. So looking at the first, and I'm doing all the study for these 2 variables, which is explaining the volume of lending. Here I'm using log of loan volume, and here I'm using loan over assets times 100. So basically here I'm using a log level regression, and here a level regression. So if you think that this may be a problem, so I present you all the results and the two settings. Okay. So basically the first one, I have no time fixed effect, but when I add this, I cannot compute this coefficient anymore. But just to say that the coefficients are here not so well, but here the coefficients are very stable. Even not being stable here, it is not a problem. But the thing here I wanted to show is that despite the positive effect of an expected Selic, this effect is very small. And what's the thing here is because I'm operating with almost 3.4 million observations. So almost everything will be significant. Even a small effect will be significant, okay, when I work with the whole data. But this effect, so this is more important than looking for the statistical significance, is to look at the economic significance. So here I provide some examples of computations. For the first case here in the columns 3 and column 6, I get this coefficient here, so try to memorize 0.11 roughly. So the effect will be that in the May month, for an unexpected increase in the interest rates, we observe an increase in lending. Okay, so and this increase will be, so for, let's say, an usual increase, right, which is 25 basis points, because I'll show you for you later that this is the most common mistake that that borrowers make, that analysts make. They make mistakes, but usually for a very small difference. And also remember that I'm using one day before, so they learned a lot before the day of disclosure of interest rates, of the Selic rate. So this effect is very, very strong. And also when I compute for the other coefficient, it's still fine, a quite large effect. But here, remember that it's mixed because of the assets over in the denominator here. But both effects are very, very strong and more than statistically significant at 0.1%. They are economically meaningful as well. Okay, so this is the main result that I show here. It's robust to the inclusion of controls. The standard error cluster at the municipality level, because it is the market, the credit market that I'm exploring. So it makes sense to cluster at that level. And that's it. So now I will show you about the timing. So what I do, I report this very same regression here, but I'm expanding this May month in 11 coefficients, one for each month, and using December as the baseline. So what do we see here looking at these four graphs? Running the regressions with controls or without controls, the pattern is more or less the same and similar. The pattern is very similar from including and not including regressions, controls in the regressions. And it's quite similar as well when you have two different variables. So basically January is the month in which you have the highest protection compared to December, which is the month with, because see, all the coefficients here are negative, and those that are not distinguishable from zero. So all the other months offer a smaller protection than December. And I see here that months like June, see June here, June here, June here, and June here, are the months in which you offer more protection. January and December and July are the months when you have least protection. And here February, you see also low protection for the individual. So this is basically looking at the data. Okay, I will. The explanation for this is that after these periods, so remember the idea that most of the results from Oliveira and Tenreiro, this evidence comes from the employment data, right? So here, after talking with several loan officers, one possible explanation, here I have two, but I cannot deeply explore them, but it is basically that because of vacancy, because of taxes payments in which individuals have to borrow money. I've heard from a loan officer, which is very interesting, that people get a loans to go to the carnival in Brazil, which happens in Fevereiro usually, and March sometimes, but they borrow money to have a better experience in the carnival, and after that they start the year. We have this common say that in Brazil the years start after carnival. So maybe this case for individuals, but the other case that also explains the result is that individuals are getting loans to pay IPVA, IPTU, those taxes that if you pay with in à vista, I forgot this in English, but if you, sorry,
in full.
So if you pay in full, you have you receive a large discount So maybe the case that people are getting money to pay this info. So these two explanations are I cannot distinguish with my data, but this is definitely a case for these studies. And also exploring the heterogeneity. So I cannot find different effects for size. Remember that my average effect was 0.11 for this variable and 2.3 for this one. So here I find small effects in all the samples, but not distinguishable of between them. So size it was a variable that I could explore, but I couldn't find a distinction effect for every sample. However, for share I could find. So in markets which are close to monopolistic, in which you have branches close to monopolistic settings, there is no effect. See, here we find some effect, but after including controls, you see no effect. For those branches in the middle, they start to offer some protection, but see, this is half the effect for the firms, for the branches that are in markets with small market share. So those branches that have a small participation in the market, this is consistent with the idea that they are taking advantage of its main month to offer larger loans, to offer more loans to their clients in order to increase their market share. Also, I find that private branches do all the branches, the private and the foreign branches protect their clients, but private branches do it with a larger coefficient here. The coefficients for the other two variables are quite similar, but what is more interesting here is that public branches do not appear to protect their clients. So as if they are not competing with other branches for their clients, and this is consistent with evidence from several sources for Brazil, from abroad, that public branches do not they have different social functions rather than only providing credit or competing against market. So if my rationale about marketing competition is correct, this is what we expect to see in the data. And further, which is one of the analysis that I could do, I separate the data in branches that are present for the whole period, 180 months, and those that are not present for this whole period. So maybe firms that branches that enter later, branches that enter and at sometimes leave, or branches that enter at the beginning but leave before the end. So I see here that branches. So this is a proxy. This is most important. Not being only present, but being in the market. It's a proxy for relationship length. So relationship length, for how long these branches know their clients. And here I see that the coefficients are, in this case, is more than the double for the coefficient of not always present. It's also slightly larger for low and over assets. So this indicates that branches that have longer relationship with their clients do protect more, which is consistent with several literature evidence that we have in the banking literature. So both protect, but those with longer relationships do protect more. For robustness, I present several results. I'm not going to each one, but here I want to say that it is expected that in larger markets, the effect markets with more with larger branches, they can drive more of the results. But if I go here, I see that the coefficients basically don't change when I weight by size. So the results is also robust for weighting. I also doing several subsamples. For instance, when I remove state capitals, the effects are still quite high. The only one that is slightly lower is for removing no crisis period, but this is consistent with other evidence that branches will protect more in crisis periods. However, the effect is still present. If I, instead of requiring 5 years of data, I require 7 years of data, the effect is also observed with the exact same coefficient, so no problem at all. If I get markets with more bank supply, which is with more banks offering credits in that municipality, I observe the same results. And with 20 banks or less, I still observe the same results.
Luis, 5 minutes, okay?
Okay, thanks. And if I do use the continuous measure instead of transforming into a dummy, I still observe the same effects. Here, I even find a negative effect for the expected leak, but as I said, it is not the main goal here. The main importance is given to these two variables, which I provide in the written version of the paper some calculations, but basically these are also economically meaningful effects. So going back, so these are all. So now you hear me again, right? Okay. So I don't know why, but my phone turns off 20 minutes, I guess. So, and another interesting analysis that I do, which is also referred to robustness, but that provides me more insights with respect to the analysis forecast, is that I actually, instead of using only 1 day unexpected leak, I also use it periods in which I see that individuals, mostly these forecasters, professional forecasters, the periods in which they mostly adjust their expectations. So here I plot, I show a table showing this median forecaster error. So see, most of the times the median forecaster did it correctly for the 180 possibilities of making a forecast. Most of times, see 80% here or 66% here when you're in 30 days before. So they do a very good job. And what is interesting to see is the mistakes in most cases are of 0.25, or in other words, 25 basis points. And that despite making a very good job, as I will show actually in the next slide, when I do the regression, instead of using the first day Selic, so these two columns here, I'm basically repeating what I've done before. When I do it with a 5 days prediction, 15 days and 30 days, we see a decrease in the coefficients from one period to the other, almost monotonic decrease, indicating that if someone uses in my case here, I could find the result, but this will be translated into a very economic small effect. And if you do this with a larger window, you may find no results because the coefficients become very small. So you are not indeed capturing an unexpected change in interest rates. Okay. So this is important because there are several other studies and from Brazil that use 30 days. So here I'm using taking advantage of data to obtain a more deep measure. Okay, and another important thing is that this coefficient more than doubles, a bit more than doubles, when you use the difference from 5 days to 1 day, indicating that forecasters adjust their predictions mostly in the last 5 days of a coupon meeting. So what we learned to finish, we see that branches protect their clients from changes in interest rates, even for contractionary policy. But this also impedes the transmission of monetary policy, clear transmission of monetary policy through the bank lending channel. For individuals, it is good for individuals to know its May month. In previous versions say, okay, learn your May month from your branch because it will be easier for you to get loans. And to develop private long-term relations because it will be more protected in cases of increased interest rates. And the policy implication is that if monetary authorities want to be more effective, they must take into account the optimal composition and the timing for changing interest rates. Okay, thank you for attention, and I hope you provide me good feedback for this paper. I'll stop sharing right now.
Thank you very much, Luis. Now I'm gonna to make my comments about the paper.
Great.
So it was a pleasure to read your paper. And so my introduction here, so it's a very interesting paper. The empirical estimations are very straightforward, so very easy to understand what we're doing in your estimation. No fancy stuff going there, because you really don't need, because of the size of your data and your identification strategy. So we have a clear practical implication for policy transmission. So sometimes it's hard for some papers to make good policy implications. Sometimes they stay more theoretical. And here you can see, okay, there is some lessons to be learned. It's a very novel topic to use this data in Brazil. But now my points. So my biggest point when reading the paper is the following: what is the distribution of the COPPEAD meetings during the year? Because I put here 2022, 2023. You see that it's February, March, May, June, August, September. Then there is a change, October, November, and December. Although there are every 45 days, because they almost never are in January, then you have this effect, okay? And even if they're in January, I think 2023 it will be 31st of January and 1st of February. So it only influences the interest rate in February. So what is the distribution of the COPPEAD meetings during this year? Why? Because if the meetings are stacked like this, they are always occurring the same months, then the distribution is not uniform. So we cannot estimate figure 3, because they have very few for January, very few COPPEAD meetings, and because there are very few COPPEAD meetings, there will be very few changes in interest rates. So then there is a problem there. Additionally, what I think that may be an interesting thing there is that is there a more likely meeting in which a change in Selic may occur? For example, is a change in June more likely than a change in December? So meaning that what is the probability that the COPPEAD will change based on the previous ones? So for example, there is a 5% chance that 5% chance that they will change in June because of previous, but there is like a 15% chance that will change in December. So is COPPEAD choosing the months already, meaning that are they like not doing much in February or December, and then stack in the middle, or not? So I think that that may be another interesting kind of or robustness or a kind of additional result to see if there is a main month for the central bank, meaning that is there a month in which, okay, this is the month that they more likely to change, and what happens if they change in that month? That may be interesting. You also have a phrase in our paper saying, in addition, exclude branches that have reported zero lending volumes. These branches business are not related to the credit market. So how many observations were dropped, and does this introduce bias to estimation? For example, are branches with zero lending volume more correlate with the heterogeneous variables that you use in the appendix? Because if that is the case, then you are just saying, okay, you are excluding more branches in one bin than another, and then when you use these bins as your independent variable, then you have sampling problems, because you already took out the people that do not lend from there. And you did a better, I think, a very good job in your presentation showing the hypothesis, but I think that when I read the paper, they're not very clear. Okay, they are in the text. So in page 8 for testing the hypothesis. So what are the hypotheses that you want to test? So I think that your paper does not go for hypothesis, much better research question. Have the research question. What is the effect of transmission of monetary policy when you have the month that the people lend more. Additionally, I didn't put it here, but it occurred to me during the presentation. The following, because October, November, and December are like 56%, 56, 57, I don't know now, the sum of the main months in the whole data, can you use the last quarter and see if changes in the last quarter, what is the aggregate effect? Okay, so if you take a change in the last quarter compared to the other quarters, because everybody is like a herd effect, everybody's like protected in these months, then what is this kind of a big effect? I think that you may kind of do the regression like an aggregate effect in the whole of the economy during these 3 months. Are changing in these 3 months less effect than the others? Because if we find that in general, then we say, okay, there is an effect in the whole economy, okay, because of this last. So changes in the last quarter that are not as efficient, and this solves also the problem that was before. Why? Because then in the last quarter I have 3 months, so this heterogeneity in choosing the dates of the meetings is less of a problem, because I take 3 months and you're bunched together, much better than taking 1 month to take in December. So I think that quarter is interesting. Another thing is that the estimate suggests that an increase in 25 basis points during the main month has an increase in the loan volume by roughly 2.7%. That's our main result. And I was thinking, are the results symmetric? Meaning that does a decrease of 25 basis points during the main month decrease in loan volume by about 2.7%? So you can segregate, okay, by unexpected positive change and unexpected negative change. The negative, even with and then more than that, you can have the market was expecting an increase and there was not an increase, or the market was expecting a decrease, but it was a bigger decrease than expected. So because we are using expected Selic, then we have 2 different sources of variation of variable. Either the market was expecting something and something did not happen, or the market was expecting something and something more extreme happened, because I think it's very unlikely for the market to predict a decrease and there is an increase. So either it predicts an increase and there is nothing, or a decrease and there is nothing, or predicts an increase and there is a bigger increase, or a smaller or a bigger decrease. So I think that by segregating these, you can provide more one, robustness, and 2, you can maybe find stronger results because you're mixing everything together. Okay, so for example, you say that, okay, there is a change of plus 25%. Is it plus 25 because they were expecting nothing and there was an increase, or they were expecting 0.25 and they increased a half? So segregating the results, for example, for increasing the half, it may be a bigger result. So the increase was bigger than expected. Then there was an increase and there was no increase. And my final main point is, can this be solved by the central bank using better forward guidance rather than changing the monetary policy when they choose to increase or decrease the Selic rate? Why? Because you are using forecasts. Forecasts mainly a product of the forward guidance that the central bank issues. So if the central bank issues forward guidance, okay, we are going to increase. Next COPPEAD meeting will continue the increasing, then the market say, okay, we are going to expect 0.25, 0.5. We're going to continue the increase in the same velocity, and they increase half, so we expect a half. Or you're gonna be increasing, but not as rapidly as we did before. So they're going to expect 0.25. So what they're saying is that there are two different ways that the central bank can do that. The central bank can make that change by changing the timing, or by issuing forward guidance that are more that are, how can I say, more specific, that makes the predictions better. Can either change the timing or make the predictions better. Okay, and I think that this may be an additional policy implication, meaning that not only what are the effects of the change in interest rate, but also how the defective forward guidance of the central bank may have effects on the economy. Because, okay, I changed, but if the central bank is not doing a good job in making forward guidance and is making the analysts make erratic predictions, then this may create lots of unexpected Selics, and because of that, market may be reacting to phantom stuff. Okay, and I think these are my and now the minor points. Appendix A, when you put the variable, they are very difficult to understand for non-Portuguese speakers, because cash holdings, I know that's cash over total assets because I can read that is caixa over total ativo. But I think that instead of using the name of the variable, use the meaning in English, or put that in parentheses, make it better to understand. And also, I saw there that the millions, it's very hard when I look 3387647, that 33 million, 3.3 million. So you use the comma, then it becomes easier to read. Okay, so thank you very much. Thank you for making this very good paper presentation. Do we have questions for the audience? I don't think so. So while you may ask questions, I'm gonna do another thing here, is that to show the next presenters. Okay, so next month we have Professor Manuela Dantas from California State University, and in October I'm gonna have Gustavo Araújo from the Brazilian Central Bank, and then in November I have Matheus Moura, PhD candidate at EBAP, Getúlio Vargas Foundation. In December we will have Professor Roberto Tomasetti from the Federal University of Rio de Janeiro, from accounting. And February, we're going to have Sérgio Guimarães from the Brazilian Development Bank, that's BNDES. March, you have André Carvalhal, who is here from COPPEAD. He'll present his paper. And then in April, we're going to have Professor Jefferson Colombo, who was also a professor here at COPPEAD, but now is in ESP, Getúlio Vargas Foundation School of Economics in São Paulo. So these are the next speakers. September, October, November, December will be, September, October, November will be in the last Wednesday of the month. December will not be in the last Wednesday of the month because it's kind of being like very close to the New Year, between Christmas and New Year. So probably be in the first or in the second December of the month. I'm going to check with Professor Roberto to see which is going to be the presentation. And then in February, March, and April will be in the last Tuesday of the month. Okay, so these will be the dates. Now we have, so it's 3 o'clock. So I thank you very much, Professor Luiz Claudio, and the other attendees. I hope that you may find that the contributions, the topics that I put forward here in the discussion may help you in the development of a paper. I also thank, because it's also being broadcast on YouTube, for those of you who are either watching on YouTube or gonna watch later. So also thank you. And I make here the invitation for you to be again with us next next month, in the last Wednesday of the month, with Professor Manuela, present a paper in more accounting, less finance, more accounting, but that's the top, that's our research lab, both papers in accounting and finance, and also sustainability. So thank you all, and see you all again next month.
Thank you, Rodrigo. Thank you for everyone. See you.
Bye.